Let's have a sesh on operating profit margin. This is relevant for you if you do A-level business. So operating profit margin, you will find the numbers you need on the income statement, the profit and loss account. And your operating profit margin is the formula, your operating profit divided by revenue times by 100 because it's a percentage. If we look at an example here for Chocksesh in 2020 for their operating profit margin, the way we calculate it is firstly we find the operating profit, and the operating profit is simply going to be your revenue minus your cost of sales minus your operating expenses, and you'll come to here your operating profit, and your operating profit is 50,000. So 50 will go on the top, and then on the bottom your revenue is going to be here the 200. So 50 divided by 200 times by 100, to put it into a percentage, means that you're going to have 25% for your operating profit margin. And what that means is that for every £1 of sales that this business makes, 25p is operating profit. Things that you need to know. Number one is that operating profit margin, OPM, you want it to be as high as possible. The bigger, the better. Number two is it says how good the business is at performing, at its performance, at its operating performance. And that's why it's a core indicator of how well the business is performing. Because it doesn't include debt and it doesn't include taxes, because it's not net profit, it's operating profit. It's not including any interest you may need to pay on your sources of finance. It could be a big bank loan you've taken out, for example, and it's not taking into account taxes you have to pay, which is why it's sometimes referred to as operating profit is referred to as EBIT, earnings before interest and taxes. Number three is that it's really useful for management to know what their operating profit margin is, because they can, as a company, look to previous years and compare and see how they're trending. Are they trending positively versus the previous year? Or is it they're trending negatively from the previous year? And if they're trending negatively, then they can look at the operating performance margin to tell them that, and then they can work out from their income statement how they can fix that. Additionally, you can compare to rivals in the same industry as you, because you can again see what your rivals have margin. Maybe it's better than them, or maybe it's worse than them. And if it's worse than them, what are they doing that's better than you? Because it's got to be either their revenue is higher than you, or they're producing cheaper than you, or they're keeping their expenses as lean as possible. It has to be one of those at least, that they are doing better than you. How can you replicate that? Can you replicate that? They're the questions you need to ask. And number four is, as I said before, it's looking at your direct costs and your indirect costs, and that really helps establish your operating performance, your performance as a day-to-day business, not including any taxes you have to pay and any interest you have on your long-term debt. Let's get technical here. So if we're absolutely technical about operating profit, which is part of the operating profit margin, it is in fact the formula revenue minus cost of sales minus operating expenses minus the depreciation of any fixed assets. So if your long-term assets have lost value over time, well then you need to include that in your operating profit. This time not included but instead excluded is that, as we said earlier on, interest isn't included in the operating profit, and nor is any investments. And maybe you have a percentage stake in another business, because this is common with businesses. And that other business that you've got perhaps a 25% stake in fact makes profits, and that means that you've made some additional revenue. Well, that's an investment, and that's not included in the operating profit, and therefore not included in the operating profit margin. Last things to know is that number 6, operating profit margin, it's always going to be a bigger percentage than your net profit margin, simply because of where it's positioned on the income statement, and it's always going to be a smaller number than your gross profit margin, simply because of where it's positioned on the income statement. And the final thing is, of all these profit margins, operating profit margin, I think, is seen as the core performance indicator and perhaps the best of all of them. And that's why it's included on your ROCE, your return on capital employed. And a way to remember that is the O in ROCE stands for operating profit. It's a good way to remember that for that formula. I'll see you at the next sesh.